All right, so what's in my stock market portfolio this week? So let's start off with my margin account first. So I've got 23 shares of Apple that I bought at an average price of almost 180. Looks like it's climbing up today, so closing the day at 179.84 looks like. Actually closing at 178.9, but after hours it's at 179.84. I am probably going to sell it at cost just to get the funds out of it and use it towards something else, something that I can buy and write covered calls against. Got AMD that I bought at 22.97 and I sold call options against at $1.50. Today it rallied back up at 22.96. So right now it's below my strike price of 23, but last week it was almost at $22. So hopefully it ends the week below 23 so I can keep the shares and sell call options again. But if it doesn't, then my shares will get called away, but I will have already collected the $150, or even maybe depending on how far off $23 it's trading at, maybe I can buy back the option and then sell next month's option if it's worth it. It's something that I'll decide come Friday. Got Ascendus Pharma here that I bought at 72.3, closing at 125.29, but I sold call options against it. I sold the 50 strike price, so for sure it's going to be in the money and it's going to get called away. But the difference between the option collected and the strike price that I'm going to sell at gives me a profit of about 7% in 1 month. So that's basically why I did this trade, or I bought this stock. Got Activision that had options expiring March 1st, I believe. So it's actually due for options or call options for me to sell. But I keep placing an order at $1, but it doesn't reach it. I don't want to sell under that because it won't be worth it if I sell under that. So I've got 200 shares, so I can basically sell 2 call options at $1. It's trading, I think the highest today was 95 cents, but I'm going for $1 and I'll just place the order again. Looks like it tomorrow should be, if the stock continues to go up, it should get executed tomorrow. Got Bristol Myers that I bought at 50, selling at 50 strike price, collecting $2.28. Right now it's trading at 50.9. So if it continues this way come March 15, I can either buy back the option and sell another call option the following month, or I could just let the shares go, get my money back. I would have made my 4 or 5% in 1 month and then look to buy something else. I've got Groupon that I bought at 2.9, closing at 3.4 today. And option wise, well, I sold at 3.5 strike, so it looks like it could stay below 3.5 come March 15. If it does, great, I'll sell call options again. If not, I have the choice again, either to let it go, let the shares get called away at 3.5, so I'm still profitable because I bought it at 2.9 and I collected options I think 3 months right now already with Groupon, or I could buy back depending on the price. I could buy back the option and then sell the next month's option. Got JD.com, this one for sure is going to get called away. I sold the 25 strike price. It's trading at 27.62, so I don't feel like buying it at $2.70. I don't want to buy it more than what I received. I've got Kraft Heinz. This one, I sold the 37.5. I should have sold the 35. I was hesitating between both. At the time I sold the 37.5, the stock was trading at 35.2, I think. So definitely, or even below 35 actually. So I could have collected higher premiums if I sold at 35, and look at it trading at 32 now. So for sure it's not going to get past 35 by Friday, and definitely not past 37.5. So I'm going to end up keeping the shares, and we'll see next month at what strike price I'll sell call options. Macy's, same thing. I bought at 25.82. I sold 2 months in a row already call options for Macy's. Every time it trades below 26 come expiry date. It looks like it's going to trade below expiry date, below 26 come expiry date again, because it's at 23.5. My strike price is 26. In fact, I could probably close out the option here that I sold at 87 cents. I could buy it back for a penny and then sell immediately the next month call option instead of waiting for Friday. Or I could just wait for Friday so I don't have to buy it back and let the shares expire worthless. So since I bought the stock at 25.81 or 82, I want to pick a strike price that I'm comfortable selling the stock at. So it would probably be 26. Right now the April 18 call option is selling at 15 or between 15 and 19 cents. I've got Morgan Stanley that I bought at 40.44, right, closing at 41.85. This one for sure is going to get called away. My strike price is 41. I've got Six Flags that I'm going to end up keeping This one was trading at 57 at some point. I bought it at 54, but now it closed at 50. So I sold $1.50 call premiums, and right now they're worth 4 cents. So most likely I'm going to end up keeping, and then I can sell call premiums the following month. Because Snapchat, that was just an experiment. I sold a 2-year call option, so they expire in 2021. So there's really nothing I could do right now except buy it back at $4.35 and then sell the shares at 9.96. So that would be an alternative if I want to free up the money and use it towards something else. I've got SNC level line that's definitely going to get called away. Bought it at 34 and then sold call options at a 34 strike price, collecting $1.45, closing today at 35.52. So it's got a pretty good chance of getting called away. I don't plan on buying back the option and selling a higher one. Got Twitter that I bought at 30.5, closing at 30.87, and I sold the 31 call option. So this one has a chance for me to keep and then sell call options again. And I think the following month it'll be about $1.37 as well. So it's going to be a good return if it trades in that range and below 31, of course. Got Weight Watchers that of course is killing me because I bought it at 30 and then it dropped 30% or 37% after earnings and closed today at $20. So I'm down 33% on the stock, so $2,000 as you can see here. But I collected $3.60 on the stock, so at a 28.5 strike price. So for sure I'm going to end up keeping the shares because it's trading at 20 and my strike price is 28.5. I already collected 3.6 out of it. So if you look at my price of 30, I actually collected 3.6 divided by 30. I already collected 12% from my purchase price initially in 1 month. But now the following month, I need to pick a strike price that's close to 20 in order to get a decent return. But at the same time, it's hard for me to choose a strike price close to 20 because I don't want my shares getting called away at that strike price if it's far from my $30 purchase price. So I have to choose a strike price that I'm confident the stock will not surpass come 30 days. And I've got United States Steel that I bought at 21.81. This I've sold probably 3 months in a row. Most likely I'm going to end up keeping the shares and I'm going to sell the following month's call premium or call option. Actually, let's see what it's trading at right now. This month next month, the call premiums won't be so high, I realized. So if I want to pick a 22 strike price, because I bought the stock at 21.81, I'd be collecting 41 cents. So it's not that high. So it really depends on what the stock is trading at come Friday or come Monday, March 18. In my TFSA, I've got Chesapeake Energy. So this I bought at 2.8. It's trading right now at 2.75, but I sold call options at 9 cents. And at this rate, it looks like I'm going to end up keeping the shares and I can sell call options again the following month. If we look at the following month's call option, actually pretty good if it stays in this range, of course. So April 18 at the $3 strike price, I could collect 13 cents and I've got 1,100 shares. 0.13 divided by my purchase price of 2.8, that's 4.6% in 1 month. So that would be good if that happens. I've got the Dividend 15 Split Corp 2 that I'm keeping just for dividends. I think soon enough it's going to start paying dividends because the net asset value is very close to 15. Got some Ford shares. I've got some Ford options that I regret buying. This is just an option that I bought in order to sell in the future, but it's definitely hurting me because I bought it at 88 cents and now look at it trading at 37 cents. So I'm down almost 60% on that option. Got Hudson's Bay, 100 shares at 7.99. Got Immunogen. So this is a pharmaceutical stock that I just bought because the call premiums were so high, but I got burnt on the stock. So it dropped 53%. But I collected $1.06 per share. So it's as if I bought at 5.7, I collected 1.6. So it's as if the stock is costing me about 4.11 about. So next month I'll just have to try and sell another call option at either 4 or even 5 because at 2.64 it's pretty far off from 4. I don't think it's gonna reach $4 anytime soon. Got Kraft Heinz. I've got New York Mortgage Trust. This one I'm keeping for dividends, 13% per year. I've got Teva Pharmaceutical, bought 200 shares at 18.5, sold call options at a 19 strike price, collecting 88 cents. So this one's going to hurt me a bit because next month, see, it's already trading at 15.78, and next month, for sure I'm going to end up keeping the shares by Friday. But now the issue is, what am I going to sell the call option? At what strike price I'm going to sell the call option? If we look at April 18, since I bought the stock at 18.5, I would prefer to sell at a 19 strike price, but that would get me 2 or 4 cents, so that's nothing. I can't do that. At $18 gets me 8 cents, so also that's nothing. I would have to go for 17, which would get me 23 cents, which is okay. Or what I could do is buy 100 more shares of Teva at 15.8, so that my average price is no longer 18.5, but my average price will probably be around 16.5, let's say. So then I could confidently sell call options at 16 or 17 and get a higher premium. But then I'm going to have 300 shares of Teva. I'm not sure if I want that. And then in my RSP, I've got some more dividend 15 split Corp 2 that I'm keeping for dividends. I've got DFN.to also for dividends. And I've got some Ford shares, some more Ford options. I've got FTN.to that I'm keeping also for dividends. I've got a Honda Motor Company that I bought at 29.3, closing at 27.4. So I want to get rid of this stock because it's not doing anything for me. It's just giving me 3% dividends per year. But it's been a while that I'm holding it, so I'm going to try to sell it at cost if possible, so I can use the money and buy something else. I've got L Brands right now that's performing pretty close to what I bought it at. Bought at 26.2, closing at 26.24. I sold $1, collected 1.05 premiums on a 27.5 strike. Right now it's worth 5 cents, so I could buy it back and sell some more, or I could just wait till Friday till it expires so I don't have to buy it back and then sell some more call premiums. So if we look at L Brands for next month, April 18, so I bought it at 26.2, so I'm going to have to go for 27.5. I would collect 65 or 70 cents per share on that. Or I could probably go for a weekly option just to pick a different strike price, a closer strike price. So if I pick a $26 or 26.5, I could collect 95 cents. So I'd get less capital appreciation potential, but I'd collect a higher premium. So depending what my goal is to collect a higher premium. And if my shares get called away, well, then I'll just get my money back and buy something else with a high call premium. So I could probably do that. So instead of selling April 18, I could sell April 12 and sell it at 26.5 and collect a higher call premium. Because I don't think L Brands is going to go up anytime soon, closing all these stores. Got Novavax, which was a big mess. Once again, this is another pharmaceutical company that I bought just for the call premiums. So I don't even care about the company. I just wanted the call premiums. But I thought I protected myself by picking a strike price that's lower than my purchase price. So I bought at 1.96. I sold a call option at 1.5, collected 81 cents, making my purchase price or my cost $1.15. So anything $1.15, I'm profitable. Instead, it's trading at 51 cents. So it went way below what I collected. So I'm down 74% on the stock itself, but I mean, I did collect a high premium, and I'll just try to sell another premium again the following month until the stock recovers, but it's going to hurt me for a bit. So basically I collected 81 cents divided by 1.96, which was my initial purchase price. So I collected 41% in 1 month from this stock. And then PTI, same reason. So same thing like Novavax and Immunogen, but this one hasn't hurt me yet. I think earnings are coming out this week, so probably after earnings it's going to hurt me. But I could get out of this by buying the stock, the option back, and then selling the shares, but I don't even have enough buying power to do that. I can't even buy back the option to close it out unless I sell something else I have. And I got Vodafone that I really want to get out of. It's just giving me like 6% dividends per year, but besides that I'm down 17% on. So as soon as it gets close to cost, I'm going to try to get out of it and use the money to buy something else. That's what was in my stock market portfolio this week. I'm really looking forward to March 15 to adjust to see what I'm going to do with my call options, either buy them back or let them expire. Or I might even just buy back the call options and sell the shares immediately just to avoid getting called away, because when my shares get called away, there's a $25 fee, which is pretty annoying. If you have any questions, leave them in the comment section below. If you're going to open an account with Questrade, use my referral code in the description below the video to get up to $250. And it is tax season. If you're looking for an accountant to do your taxes, don't hesitate to message me. Link will be provided below. Thanks for watching.